Hello, everyone. This is Joseph Trevisani from Worldwide Markets. Today's topic, oil trading and the world economy, lets us cover almost anything we would like to bring in to the discussion. Technology, politics, cultural values, trading, supply and demand economics. We can do almost anything with it. I'm going to try and keep it to a rather tighter exploration, since we are all primarily concerned with the trading aspect of it. I will start there and hopefully end there. But we are going to have to go fairly far afield to cover this fascinating topic. Okay, couple of notes. Those of you who've been on my webinars before know that I prefer as much interaction as possible. So if you have any comments, considerations, or anything that you would like to bring up, please do so. I will be glad to stop, change direction, and do my best to answer the question. I don't guarantee that I can, but I will try. So let us enjoy. Let's see what we can do here. Oil. I've called this many times the premier industrial commodity of the world, and it is, you know, when I drive to work in the morning, I live in New York City and I work out in New Jersey, and so I have about a 35-minute commute. And the most amazing thing, which is over and over again, I mean, I grew up in New York, so I'm used to mass transit. But the most amazing thing I see every morning, I've thought about it this morning, of course I was thinking about the webinar as well, was those huge, endless lines of cars passing me in the other direction. Every one of them, almost every one of them, has a single person in them. It is in the United States, a very common sight. For most of the United States, everyone commutes by car. Mass transit is a rarity across the country as a whole. Of course, it's very common in New York and some of the other big cities. That consumption is the basis of what we're talking about here. That consumption, now you can make, as many people have, judgmental arguments, if you will, environmental arguments, that this is an enormous waste of resources. I'm not going to go there, as much fun as that might be. A discussion like that would be better with two people, because people are going to have different points of view on this. Nevertheless, that lifestyle, aspirational in some places, empirical in much of the world, is what drives demand for oil. It's not the only thing, but it is the marginal, if you will, change. The oil is a primary industrial commodity. I mean, it doesn't just fuel cars. It fuels plastic and a zillion other things. But the idea that oil rises and falls with the industrial development of the world is an absolute truth. One of the things that has made industrial culture, industrial society, industrial worlds, is the availability of inexpensive energy. Think of homes in the colder part of the world before central heating. We have an old house, and built 150 years ago, 1849, I think. And there was no central heating when that house was built. There are 5 fireplaces. Fireplaces are a phenomenally inefficient way of heating a home. They're better than nothing, but that's about it. All of the industrial processes depend at their base on energy. And oil, starting first with kerosene back in the latter part of the 19th century, and the whole history of Standard Oil, which is a fascinating topic in itself, it is the availability of cheap energy that has promoted and permitted industrial society and all of the creation of wealth that has followed. So to be sure, you can make judgments about this, but it is inescapable that as energy prices and if energy prices rise, then the ability of other countries, developing countries, to move into the aspirational lifestyle that I saw this morning with endless files at 60 miles an hour of cars with one person in them will be curtailed. So whatever one thinks about the energy complex, if you will, as it's often called, or oil, whether it's a good or a bad thing, whether it's going to run out, there's no doubt that as long as industrial society continues to spread, so will the use of oil. There is, on a practical basis, very little ability to change from oil. Now, yes, I know we'll hear about electric cars. I can't. They do, of course, do things, but don't forget, electric cars have to be charged and all the other things. It is the availability of cheap energy that has permitted industrial society. Okay. From our point of view, let me just see what we have here. Just want to keep track to make sure that if anyone comes in on any questions, I will see them. I want to make sure the chat list is open here. Let me just make sure. Where's my chat? Here's my chat. Okay, we're cool. Everything's up. So this is probably if I was a trader, and I am, but I was never an oil trader. This has got to be the most fascinating chart going. Look at this. How could you not have fun trading this? There's an interesting aspect to this, which I just want to point out without actually going into it, because I'm not quite sure what to make of it. Look, when the oil prices started, I mean, even if you go back, I couldn't get this chart back any further than 85. Of course, if you go back to the early 70s with the first oil shock in the out of OPEC in the Middle East, you'd see a slightly different chart. You'd see price spikes earlier on, and we're still living with the residue of that. And I'm going to talk about that when I talk about Saudi Arabia and the actual prices right now. It is interesting, though, that you start to get a sustained increase in prices about the time the internet comes into full play, around 2000, a little bit later. I'm not sure there's any connection on that. I'd like to think there is. I'm not quite sure what it is. Maybe suddenly we're all shifting money around and starting to trade oil. I think there's an actual different it looks good on the chart. Let me tell you what is another interpretation. This price spike back here, the famous one at almost 150 just before the financial crash, is a puzzle. It's a puzzle from an economic point of view. Throughout late 2006, certainly 2007 and 2008, there were signs everywhere, not that many people pay that much attention to them, but traders should have, that the world economy was in serious trouble, especially the United States. Yet oil prices spiked like bananas. Not a particularly good metaphor, I'm afraid, but anyway, there we go. I've told this story before, but not in some time, so I'll tell it again. Prices in any market, as we all know, are a function of that market. And, the old line, prices can stay irrational far longer than you can stay liquid, is true. This price spike here was divorced from any economic reality. Nevertheless, it went to 140. And if you were short, you got killed. Or if you were long, you made a lot of money. And on the other way down, you could do the other way. What happened in this early period, in the early part of 2000, I think it was a little bit before 2000. Before that point, oil and oil futures were traded here in the United States on the NYMEX, on which exchange there were limits as to how much you could trade if you didn't have a connection to the industry. Most of the trading now in oil is purely speculative. Now, it's always been a speculative market, but in NYMEX there were restrictions on how large positions you could take without an association to production. Around 2000, maybe a little bit before, another exchange in London was called the ICE, the Intercontinental Exchange, to trade oil. Any market can trade anywhere. You can make it up, rules underneath the FSA at the time. I think they've changed the name. They've changed the name since then. The British regulatory agency. On that exchange, they didn't have any limits on the size of your positions without relation to the market. So you got an enormous influx of traders. Well, to do a trade, as we all know, all you need is somebody to buy and somebody to sell, or somebody to sell and somebody to buy. So all of this volume, not created, not attached to production, started driving prices. And of course, this filtered back to the NYMEX, where they had to lift their limits or they would lose business. So a lot of this spike here is the markets kind of going nuts, following this very, very rapid trend, but following it with additional volume. If you were a new trader coming in to this market around here, and you suddenly have a margin account on ICE, and you're going to trade oil, what are you going to do with it? Well, you're going to do what everybody else is doing. You're going to go long. And so that is the source of this price spike here. It is not a market-related entity. Now, oil, relatively speaking, had been more restrained than that. I think there's probably, there's probably a factor of the internet involved in here somewhere, but I can't quantify it. In the idea that it's the ability of the internet to connect everybody through their computers makes it much, much easier to fling money around the world. So even if you are a major player, it's far easier for you to switch your interest from one commodity to another than it might have been beforehand. Again, I can't quantify that, but I think it's probably true. Okay. So now that we are back to we've created in the oil patch, kind of like that oil patch. It sounds like the old Beverly Hillbillies TV show in the United States when I was a very young child. Anyway, we don't have to go into that one. Buddy Ebsen, who was actually, I guess I will say it, Buddy Ebsen was the star of that show, and he was actually a dancer, and a very sophisticated guy until he landed this role as kind of a hillbilly. Anyway, so the advent of this market in oil has changed to a degree the way oil trades, the volatility, the interest, and also the attention that markets pay to it. Because as we all know, for traders, we may fear, but we also greatly desire volatility. This fall right here in late 2008 and late 2008 into the beginning part of 2009 is purely a liquidation of this. Right up and right down. We go down to where we started from, about here, and then we come back up again. This period here, which is we're still in now, has a greater relation, I believe, than the period of the speculative spike there to the economy and to world usage. As I started out to say, there are very good reasons to believe that oil's place in the world economy is not going to change very much for the next generation. I know Elon Musk makes great cars. I assume he does anyway. I've never been in one. They certainly look very cool because I've looked in them, but I've not actually driven one. But as far as generalized application, and as far as the ability to lift societies economically, there's nothing that can replace, at the moment, oil because of its relatively cheap production. You know, there's a great book, I think I've mentioned it once or twice before, but not for a while, called The Rational Optimist by an American journalist named Matt Ridley. And it is an answer, if you will, to the doomsayers of technology. Does anyone remember that the theory of peak oil? I was going to talk about it, but only a little bit. We're running out of oil. We've been running out of oil for at least 2 generations, maybe a little bit less. Since the 70s, people have been warning, academics usually, environmentalists often, that the world's going to run out of oil. Sort of like Paul Ehrlich and the other doomsayers from the late 60s, early 70s, that the world is going to run out of food and we're going to have massive starvation and famines starting in the late 70s. Clearly, it hasn't happened. One of the things that's very difficult for prognosticators, futurists, to take into account is the ability of mankind, technologically and otherwise, but you can just view it as a species adaptation to adapt, a species ability to adapt. The one thing mankind is very good about is adapting to different situations. The most flexible creature that's ever lived on the planet. That applies to oil and food production and many other things, but specifically with oil. The idea that we were going to run out of oil was very common because it seems logical, but it's false logic because it takes into account its presumption, its premise is that nothing changes. No technological adaptation. And of course, that is what's happened. Let me show you another chart here. This is U.S. oil production. Where is it? Where's my U.S. oil production? Here it is. U.S. crude production. This is in the past 4 years. Now, the production from shale oil and horizontal drilling and fracking, the technology was being developed before that. The chart is the application. And it is a direct answer. Now, you could still make the argument, if you want, which I won't, that for some reason oil is bad and it's bad for the planet and all those. That's not an argument I'm going to make. And the reason is not because I agree or disagree with it, but simply because it's not realistic. The desire of people. Now, I, of course, speak as an American where this is sort of part of my intellectual upbringing. But the desire of people to improve their economic status seems to me to be close to a universal aspiration. More and more governments around the world, starting, of course, with the best example of the past, past maybe forever in economic development is the economic development in China. I mean, I was in China in 1986 in Shanghai and in Guangzhou, which was then just starting to be called Guangzhou from Canton. And I remember going into and this was 7 years, I guess, after Deng Xiaoping had started the change, bringing China into the modern capitalist world. But even then, it was a very poor country. There were no cars on the streets, and I mean this. There were no cars on the streets in Shanghai. There were fleets of bicycles, old buses, and trolleys. I went into the state. There was really very little private enterprise at the time. So I remember I went into the state department store, and it was very crowded. There were people milling through there as if it was a subway station here in New York at rush hour. And there was nothing on the shelves. The glass cases. They looked like they were from the 30s, like the store had been taken over by the government sometime after 1949, but they'd never changed anything. And there was very little on display. A year ago, a friend of mine was married in Shanghai, and I very much wanted to go. I could not. And the difference, so we're talking 1986 to 2000, let's say 30 years. is astonishing. That answers, so that aspiration supports the oil market, the oil price. This is, so let me finish with Matthew Ridley. Anyway, so his book is a summary of the many types of adaptive changes in technology that have kept oil and other things, he uses oil as an example, from running out. The world is not running out of oil. It may decide for a particular reason not to drill for oil, but it's not running out of oil. It's not going to run out of oil. Because there are corrective mechanisms within a capitalist structure for this type of change. What happens when a commodity becomes too expensive for people to buy? The producers either figure out how to produce it cheaper, or they come up with alternatives. And that is what's happening here with oil. This production is probably the most important thing that's happened to the industrial world, I don't know, maybe since in the past generation. Okay, so now we'll look at, let me just look at demand here. Give me 1 second. Let me get these charts up. That's U.S. demand. Where's world demand? World supply. Crude demand. Okay, which one is this? Okay, this is the longest chart I could get for this. These charts are all Bloomberg. This is world demand. And as you can see, this mirrors the price rise, as you would expect. As the world economy expands, and that is what it is doing. Growth shifts from place to place, but it is continuing to expand. The aspirational aspect of our world is strong. And it has become very much a global culture. A global culture in the sense of people know that development produces wealth. And that wealth creation brings societies out of poverty. Gives people more things. I'm not going to have a discussion about whether having more things is a good idea. You know, there's that old joke from the 80s, just before I got on Wall Street, that, you know, he who dies with the most toys wins. Yeah, it's silly. But it is true that for my children and your children and your children's children, this is what we hope for. So that drive is behind this chart. Now, there are a number of ways to look at, wrong chart. Wrong chart. Which one is this? I got to label these charts a little bit better. Sorry about that, folks. Okay. Now this is the more recent top. This is the tail end of that chart we just saw. And this is the primary reason why we are dealing with the oil price decline that we've seen here. Let me just show you that, and then we will start dealing with some of the details of this market. My favorite one is this. I just want to put up for a second my U.S. crude production. That's not particularly useful, sorry. Okay, so where's our price chart? Here we go. Okay, this is the one-year trend, the one-year trend line in oil. Okay, now, aside from what I have been speaking about, which is the general aspect of what's behind the oil market, and why at least I believe that oil is a near to permanent necessity for the industrial world. We do not yet have the ability to replace the cheap energy, which is so essential for industrial society, of oil. I'm not saying we won't in the future. I'm not saying, of course, we should look for one. Of course we should. But we don't have it right now. So oil is likely is guaranteed, actually, to remain the most important industrial commodity that there is. So we can be sure that there will continue to be people and companies who search for, find, drill, and produce oil. So the idea of peak oil, I hope we can put to rest. What we've seen now and we'll see in the future, that oil will be produced because it's in demand. Okay, so now let us look more specifically at what we're talking about with the oil price that we've seen since the summer. We can look at oil from a supply and demand point of view. Obviously, there's more supply, drives the price down. Obviously, if there's more demand, it drives the price up, or if there's less demand. So those are two factors. But because oil is priced in dollars, there's a third factor. And I will show you that right now. Now, keep in mind this chart. This is just the price chart, but in dollars. Now, this is a comparative. I put it together on Friday, so it's the actual oil price is a little bit out of date, but not much. Oil is priced in dollars. As the dollar becomes more valuable, it takes fewer of them to buy a barrel of oil. So remember let's look at the 30-year chart here, or the 1 year, okay? We peaked in June about the latter part of June. I think about 100. I think the top was 107. Yeah, it is. There it is. 107.73. Okay, that's where we peaked. Now, back in June, what do we find? Of course, and this is one of the drivers. This is why I'm talking about this. You have to view oil from several points of view, and then they all have to be compounded, mixed together in the market. You know, the efficient markets theory, everybody has all the available information at the same time. It's not really true, but it's good as a construct. It makes for nice equations for economists, but it's not terribly real. I'd like to ask the FX Street, are we running 45 minutes today or an hour? Just please type it in so I'll know, because that'll change how I do things. Last time I was kind of cut short of it. Okay, 45 minutes. That means 15 minutes. Thank you. Okay, let's move. Let me just see the comments here. I know people are making comments, and I want to actually answer them. Yes, Ellie Mae. That is right. I don't know the actress from Beverly Hillbillies. Sorry for you people who are not Americans. I don't know that Beverly Hillbillies actually made it far overseas, but it may have. Yes. So let's talk about the dollar, the supply and demand, so we can get through this and make perhaps some sense of where we're going with this oil price. As you can see, at the end of the yellow line is the DXY, the DXY. That means the dollar index. The green line is the dollar versus the euro. And there's zero coincidence in here at the turning point, if you will, at the end of June. Dollar goes up, all sorts of reasons, many of them having to do with initially with the ECB and Mario Draghi and all of that. But there's more involved, and I'll show in a second. So we have a very profound trading change in the value of the dollar. The value of the dollar is predictive to some degree. Now, what you'll see is the oil price has come down about 25%. The dollar, I didn't chart the DXY, but in the euro, the change has been a little more than 10%. So clearly, there's not a 1-to-1, maybe there's a 2-to-1 correlation. Other things are accounting for the change in the price of oil. But this is a signal that if you're an oil trader and you take a look at the dollar chart and it looks like the dollar is starting to ascend, and there are good reasons for it to continue, as we all know. ECB, slowdowns in growth, all sorts of things, better growth in the United States, the rate cycle in the United States, which whenever they finally get around to raising rates, the next move in the United States, unless something blows up, is higher. And that is certainly not true in the ECB. So all of these reasons behind the dollar and the move in the dollar relate specifically to the oil price because they are likely to continue. That means back in June and July, and I get, all of the forecasters, the analysts who said that the dollar will strengthen this year, they had to wait a long time. And some people said, oh, they don't know what they're talking about. But in fact, it's been true. It's just taken longer. The fundamentals for the dollar and for the U.S. economy have, over time, made themselves known to the traders. It's been clear for most of the year that the U.S. economy is performing better, as it usually does, than the European economy. The biggest change was that the Europeans, and the person of Mario Draghi in particular, began to recognize the problems in the euro, and the statistics out of Europe were beginning to back this up. So the larger change was on the European side, but it didn't matter and doesn't matter as far as traders go. The dollar can go up because the U.S. is stronger. The dollar can go up because the Europeans are weaker, or both, as is the case now. But it became clearly evident by the beginning of the summer that this was the next trend. Dollar up, oil price down. It's my guess that the move in the dollar probably predated some of the other conditions, supply and demand, because the currency markets react more quickly. And it takes a while for the economic news to amass to a critical level, critical mass, if you will, that it becomes the accepted view. The dollar and the currency traders tend to move quicker. Okay, so that's the first thing. And in my view, that's probably the thing which got the oil traders' attention first. Okay, then we have, let's go with demand. Okay, but let's start one step back. This is European GDP. I deliberately did not put up U.S. GDP because it is the change in the marginal change, the change at the margins, which affects markets more than anything else. And the change in European GDP came right about there, second quarter. The third quarter is coming out on the 14th, I believe. So we saw a decline, and it's an accelerating decline. It's gotten much worse. But this is what started to get the markets. Now, European demand is less flexible, if you will, because it's a fully developed industrial world. And the marginal change in Europe has never had a great, it doesn't have very high growth numbers. It tends to be a bit of a stagnant economy. They're trying to change that. Things are complicated. I'm not going to pass judgment on that or even comment on it. But anyway, so you saw in Europe a sloughing off of economic growth. But more important, and this has got everybody excited, is this. This is China, of course. There's always more demand coming out of an expanding economy. An economy where many, many people, as I said earlier with my little story about Shanghai, there were no cars on the street except for maybe party vehicles in 1986 in Shanghai, the commercial capital of China. There are quite a few now. That kind of growth is far more dynamic than the percentage change in a fully developed economy like the EMU's from 1% growth to 3% growth. So for the marginal demand in oil, the developing world, although I'm not sure China should still be classified the developing world, I think it still is far more important. So this growth here, and not only that, there's a political aspect to this as well. and that is that the new premier, Li Xing, yes. Yes, I understand that. It depends on, there are various measures year to date and others for China's GDP. I chose 7.3. There's another one that's 7.5. That's correct. So these two changes on the demand side, and you can tell that oil prices have come off, even though the United States, the world's biggest oil user, crude oil user, its economy is doing better, is growing a little bit stronger. So it's the marginal use of China, my view, that had the most impact on the oil price. Okay, so we have the demand side. And let me just put up the demand here so we can see it, okay? This is a 20-year chart in world demand. And we spoke about this. This is part of the aspirational aspect of world economic culture, which is what I'm going to call it. I'm not an academic, so I kind of choose my own language for describing these things. I come to this as a trader originally with quite wide study in economics, but I'm not by any means an academic. So if there are people out there who are used to different ways of describing these things, please bear with me. Anyway, so here we have again, and look at the usage correlation. We saw oil prices. Remember, oil prices trade in futures contracts. We saw the oil prices top out about in June. And where do we see 2 months earlier? The beginning decline in world demand. So we have, on one side, the demand equation. We have the dollar improving. We have the demand equation, which is shrinking. Primarily, in my view, because of changes in China. And remember, the Chinese government at this time has made it clear, the new government, Li Xingjia, if anyone can do the pronunciation, please do. I agree with that comment. I think that the Chinese economy is growing much slower than they care to admit. I agree with that. It's very difficult to prove. There's a commentator on Forbes, another Gordon Chang, who I've followed for a while. He actually follows me on Twitter, which I'm flattered by. By the way, I am on Twitter, so you can sort of look me up there. I do comment fairly regularly on the markets. And he said that for a long time. The problem is it's very difficult to prove it. There are very few independent statistics out of China. Most of the stuff is from the government and in a command economy, and it still is at least partially a demand economy, at least on the political side. Government tends to get what they want, so their statistics come out. So we'll just leave it at that. It's very difficult to look. It's just sort of a feeling that you have that when an economy, what they admit is probably much different than what's actually going on. At any rate, okay, so we have this crude, which one is this? This is the, excuse me. Okay, so this is the fall in crude here that we just saw on a smaller level and some of the reasons behind it. This is the world supply of crude. You already have an surplus. Remember? What's the difference here? Here's the world demand. Which one is this? Okay, world demand, we've got it 92.40 in September. Let's see what we have. This one, 91.52. Okay, this goes... Let's take the other one. This one, I think I did this one on Friday. So this one's not as up to date as the other one. Okay, so this is world supply. We already have a surplus. Now, there's not much of a difference. But when it comes to the speculative movements of a market, it's huge. Certainly enough to drive prices. Okay, so we have the difference. And then, of course, there is this, which has been going on for some time. But the U.S. is the world leader in oil technology. what has taken place in the United States is frankly astonishing. Most of this, almost all of this, has taken place on private land in the United States. Much of the land in the United States, certainly the western part of the country, is actually owned by the federal government, the Bureau of Land Management. The number of leases granted on the Bureau of Land Management in the past 6 years has gone down by about half. If you read otherwise, it's not true. Almost all of the oil production, shale oil production that's taken place in the United States has been on private land. Okay. So now let's look at some of the political aspects. This is why I love oil so much, because you can get, let's put up a crude 10-year trend line. Oh, not that one. Get this one. Okay, this is 1 year. Now, what are some of the other aspects of what we're seeing here? So oil prices are not simply supply and demand, because there are huge political factors involved, and there is a cartel. OPEC. It's been around since 72 now? 70? Or 73 when it was first active, so that's 41 years. And it has interests which are not only political. Saudi are not only supply and demand and money. Saudi is the world's leader as low-cost oil production. Somewhere, I don't know, various $10 and $30 I saw. U.S. shale oil. The price per barrel of production of what I've been reading about varies somewhere between $50 and $80. There are lots of factors that go into that. Many of them are simply related to the companies that are doing it. A lot of this has been funded by junk bonds, or high-yield bonds, as they're called sometimes. So the reason this date is here, October 1st, now, a traditional way to look at prices from a cartel is that you make the effort to keep the prices high, because that returns more revenue, or might return more revenue, to the members of the cartel. All things being equal, that's something that OPEC has tried to do in the past, not terribly successfully, especially now with U.S. oil production at such high levels. I mean, next year we're set to become the world's largest producer of oil again. This is astonishing. This is absolutely astonishing. This goes back to that book, The Rational Optimist, Matt Ridley. I suggest you all read it. It's a little bit long. The argument gets a little thin at the end, but it is a very good antidote to the doomsayers, because doom has not come about. Most of the doom that has come about has been mankind. Well, never mind. That's going to go political. We're not going to do that. Exactly. So what's going on here? What happened on October 1st? The Saudis, instead of restricting production, raised production. Actually, they raised production before that. On October 1st, what they did is they offered discounts. They didn't actually reduce the price, offered discounts to their Asian customers. And you can see what happened there. That told everybody in the market what the Saudis are interested in at the moment is market share. They have a huge kitty, $735 billion, I think, in reserves if they need to use it. They have very low oil production costs. So what do they gain by doing this? Well, they gain two things. One is political and one is economic. They put pressure on the rising oil producer. Who's the rising oil producer? U.S. shale oil. Because the costs of U.S. shale oil are higher than Saudi's fields. Now, what's also true is that the costs will come down. As with almost every other technological process, it improves. I mean, 10 years ago, there was no shale oil. So you can be sure that, one, the process will become more efficient and cheaper, and two, the more efficient producers will take over the inefficient producers. So the Saudis put pressure on the U.S. shale oil industry, which of course is a direct competitor to them. But the second thing they do is also important. Saudi Arabia lives in a rough neighborhood. Some of its major enemies in the Middle East, political enemies, Iran, ISIS, others, are also oil producers. And if Saudi can bring the oil price down, which obviously it did, it went from 90 to 75 to just over to 76. I think this is WTI. This is not Brent. And now it's back up to about 80. So if you're an oil trader and you're looking at both the supply and demand economics and the political and supply and demand economics on Saudi, and Saudi is still the world's largest marginal producer. They have more ability to, I think I read that they're producing 9.6 million a day. U.S. is what, at 8.3 now? But they have the ability to raise that to 12.5. Maybe not immediately, but within a few weeks or whatever the time frame is. So as far as the ability to affect oil prices, traders, ICE, NYMEX in New York, the Saudis have the greatest sway. Also because it is a monarchy. That means somebody makes the decision. If the U.S., the American government can't go to say, we decided to raise oil price. We're deciding to raise production. How? How would they do that? They can't. It depends on thousands of individual drillers, individual companies to make this decision. And they will make their decisions largely based on market forces. So President Obama can't say, let's raise oil production. He can make the conditions more congenial for that, but he can't order oil production increased. The Saudis can. Now, that's not entirely true. They could release, if they wanted to, they could affect prices on the downside. They could start to sell oil from the strategic reserve, and that would bring prices down. But they cannot command U.S. oil production be increased. The Saudis can do that. So from a marginal point of view on the effect of the price of oil, the Saudis are the determinant. And you can see that specifically from this chart. Okay, so we've covered both the supply side, the demand side, the technological side, and the political side. A little bit more on the politics here. Oil is one of the commodities that is affected by political developments in a way that, say, more strictly industrial commodities are not. What do I mean by that? One of the other things that supported the price of oil was the arrival of the Islamic State in eastern Syria and northern Iraq. Without making any comments on the politics of the situation, yes, absolutely true, does hurt Iran and Russia, its competitors, including hurting, I'm talking about one of the comments on the chat, including as I said, the shale oil producers here in the United States. And that's just business. As they would say in The Godfather, that's just business. Strictly business. But its effect on Iran is not strictly business. Because Iran is a Shiite competitor to Sunni Wahhabist Saudi Arabia. They're not friendly. They're very close to enemies. In fact, they are enemies. So the politics of it is definitely part of the mix. So one of the things as with all markets, it's the new information, it's the marginal information that has the most effect. And one of the things that had happened in the Middle East was the rise of the Islamic State over the summer and a little bit before. That also, at the time, seemed to have the potential to disrupt oil supplies. Now, it hasn't turned out to be the case, but so far anyway. But there was a time in the beginning of the rise of the Islamic State, when it first hit the news wires, that they were threatening Baghdad. I don't think that was ever really true, but it was certainly portrayed that way, and it would be something that would have an effect on oil price. That has diminished. So you have yet another factor, but the proximity of the largest marginal producer, Saudi Arabia, to potential political turmoil is a very unusual factor, if you will, in the price of a commodity. For instance, gold, wherever it's produced, rises and falls with demand, with industrial demand, of course, with jewelry demand, with safe haven status, with inflation and fear of inflation. But except if the political turmoil is very widespread, it doesn't really rise or fall that much with that kind of issue. So here we have an unusual situation geographically displayed in the Middle East. Okay, I'm going to have to end here. I know because we're running 45 minutes here, but let me just say a few closing words on all of this. Lower oil prices in the world cannot but have a beneficial effect on the world economy. One of the standard analysis of the world economy since the financial crash and the recession, and I think it's really beyond that. It is a problem for the world in general, and that is demand is insufficient to production. It's far easier, and many countries have done this, and many companies have done this, to ramp up production than it is to create demand. It takes a long time to build wealth and to spread it through the culture. It takes a long time, usually generational, for people to move from class to class or from economic level to economic level, if you will. But it's much easier to build a factory and have 500 million more blue jeans produced every year than are needed, or however many. One of the things that a lower price of oil does, it is a direct contribution to demand. The money that's saved by consumers, including myself, when I fill up the car, and everyone else who has a car or does anything else, becomes a contributor to demand. And I think this is true everywhere around the world. And so from that sense, the feedback loop is, as you would expect in a market-based economy, is relatively strong. We spoke about gold recently. Gold is a fascinating topic, but it's quite different than in its structure, in its demand structure, than oil. But I'm not going to go into it right now. So the result for the world economy and including the United States, and including China and India and Russia and everywhere else, of a lower price of oil is a stronger set of consumption figures. And this will end up, of course, benefiting everything around the world as far as the economies go. So let's just go over this once more, and then I'll have to end because I know we're running out of time. The supply side, the largest, I think, effect on the world price has been from the supply side. There's been some from the demand side, but because demand and the largest variation in the largest marginal change in the supply side has been the U.S. production, which it's clear will continue and is probably more flexible than it appears to be. Not as flexible as Saudi Arabia, nevertheless flexible. After all, there's going to be an election in the United States in 2 years. It is quite possible that someone else gets in, or there's a new president who will have a different view of opening up federal lands to drilling. It's possible. I'm not saying it's going to happen, but it's possible. That's on the horizon. Technology will improve. So the supply side is something which we can count on. The demand side, which has come off has to do with slowing economies in Europe and in China, but the demand side as a whole, seen longer term, will continue to rise. So that's why I say the supply side had more effect on this price move than the demand side. The third factor, of course, has been the rise in the dollar. But of course, as we all know, the dollar rises and falls. This is a trading factor, but it certainly is an immediate contribution to who goes long and short in the oil market. So all three of these factors have played their role in this particular oil price move. Now, as far as the future goes, it's my view that at the moment we've probably reached the temporary bottom, because after all, the move that we've seen in oil prices, where's the oil price here? Okay, this is an oil price. Let's get a little closer one here. This one right here. Let me just show you this one right here, and then we will end this, the 30-year oil price. Okay. We have if you look here, we have a pretty reasonable set of technical, in the widest sense, tops and bottoms running about through 78, 80 right here. So there's no surprise that we have paused here. If you ran a Fibonacci here, you would probably get this at about the 50% level. A little bit less, I think. So for the time being, without any further developments in politics, and it's always possible, or a substantial change in the world economic situation, a much deeper fall in China, deflationary prices in Europe, the inability of the ECB, because they're the only ones acting like the American Fed, to spur growth in Europe. All of these things will have their effect. But for the moment, I think we have reached the decline in oil, and we will see more of this trading from here till about 90 until we get a better sense. And also, don't forget, we have about a month more of the year until we get into the kind of the crazy markets at the end of the year. And then we start again, of course, in January. So we're only really running about another month on this, a little bit more maybe, before people start drifting off and paying attention to the holidays and their children and everything else, at least here in the West, than to oil prices and to other prices. And if you, anyone who, I'll just say one note about the end of the year markets, if you're trading currencies during the end of the year markets, take a look at what happens in the end of the year in December and then into January. Don't anybody get carried away in December. What often happens in January is a reversal of whatever happened in December. Okay, I thank you all very much for attending. I hope this was interesting. I hope it was useful. I hope you all come back for the next one. I take it as a great compliment. Yes, if I'm let me just make a comment on that. This one thing here. Yes, if the 80 level does not hold, I would say we'd get a good deal of back and forth, but the next level I would look at would be 60. I don't think it's going to, and the main reason I don't think so is because the oil demand trend is still resolutely upward. Even if you get the type of up and downs and speculative interest that you have, the overall demand is higher, and the overall price, I think, will also go higher over time. Okay, as technology improves or doesn't improve. Okay, I thank you all very much for attending. I take it as a great compliment that you come. I thank FX Street for permitting me to put these on, and I will see you in about 2 weeks, although I have not decided. I will put my email in the chat. If anyone has any comments or jokes that I can use, let me know. Also, if you have any interest in particular topics, I will be glad to cover them. One thing I've never done, actually, has been the Russian economy. That might be interesting to do. At any rate, I thank you all very much for coming. I'll put my email up there, and everyone have a great day wherever you are in the world. Take care.